Hi everyone, welcome to Investing Club. In this video, I'm going to be doing an analysis of Illumina stock. Before we start the video, I am not a financial advisor and this should not be considered financial advice. You should always do your own research and consult with your financial advisor before buying or selling any stock. And what I'm going to present to you in this video are just my opinions, so always take them with a grain of salt. Now, Illumina is the global leader in DNA sequencing. So Illumina is a super cool company in an innovative industry that is likely to have a very bright future ahead of it. On a video last week, I said I would analyze the stock that got the most comments, and this was the stock that won that. So I'm analyzing the stock Illumina based on the number of requests I got, and so I'm going to do that again. In the comments of this video, put the name of a stock you want me to analyze, and whichever one gets the most likes or the most comments, I will do an analysis of that stock. Right now, I am on the annual report of Illumina. You can easily find this by going to the investor relations page of the company. And so Illumina is the global leader in sequencing and array-based solutions for genetic and genomic analysis. And what are the main things this company does? They specialize in DNA sequencing, arrays for DNA analysis, and they also make consumables for individual use, and they provide genetics testing services. Now, this is a very high-tech scientific type of company, so if you didn't understand what I just said, I would highly recommend reading through this entire annual report, and it will tell you everything you need to know about this company and what they do. In terms of who their customers are, they have customers in the life sciences market, which this is mainly labs in universities, research centers, and government institutions. So this is one of their main markets, marketing to those customers. They also provide services to the clinical markets. Right, and they have their unique technology platform, which are these machines they sell that are actually the machines that do the genetic sequencing. So really cool stuff, and this is really an exciting company. So now we will get into the fundamentals of this company to see if they are worthy of a buy. Right now I am on the Rule 1 Investing website. This is a tool I use very frequently when researching stocks, simply because of the amount of information they hold on their website. I will put a link down to it in the description. And what we can see from this company's operating history is that they are an extremely high quality company. When you take a look at the growth rates of this company, they are pretty much perfect. They don't pay a dividend, so their book value per share has been growing at double digits. So has their earnings per share, their cash flow, the sales. All of these things have been growing at double-digit rates and don't look like they're going to slow down. They also have a return on equity of 17%. Over the past 10 years, and a return on invested capital of over 12%, and debt of only 1 year's earnings. So this is all around an extremely high quality company. And so what do these numbers tell us? Well, first, it tells us they have a good management team. The management of this company obviously knows what they're doing. They're earning high returns on equity and high returns on invested capital. So this company knows how to take their profits and reinvest it into the business to grow their earnings over the long term. And they have a conservative level of debt, so the management is closely watching that as well, making this company in an excellent financial position to outlive any sort of drop in earnings to this company. And what else does it tell us? Well, these growth rates tell us that this company has some sort of sustainable competitive advantage. That's what I say I always like to look for when analyzing a company that has a competitive advantage that will stay there for years to come, to keep out any competitors from this company's profits. So this company obviously has some very strong competitive advantage. And so what are those? Well, first is obviously the innovation. This company is editing DNA. That is something that no one could do just 10 or 20 years ago. So innovation is one of the competitive advantages of this company. Now, another competitive advantage that this company has is their market share. A quick Google search will show you that Illumina has around 75% of the global market share in the genetic sequencing industry. And so when you talk about genetic sequencing, Illumina dominates that industry. They own 75% of the entire market share. And that is not likely to change anytime soon. And so because of these things, Illumina definitely has a strong competitive advantage, and I fully expect them to continue to grow their earnings into the future. Now we can take a look at Fast Graphs. This is another website I like to use in conjunction with the Rule 1 website, and both of these websites together will give you a pretty complete picture of a company's history. So we can take a look at this company's earnings history, and so the orange line and blue line represent the earnings of this company. And And the thing that jumps out is this company consistently grows earnings, which is consistent with what we saw earlier and is consistent with the fact that they have a competitive advantage. And so a super important thing to note is, what is the normal valuation for this company? And the great thing about this website is it will tell you it. It'll tell you what the normal valuation is. As you can see, the price always stays near this blue line. And what is the blue line? The blue line represents a 50.53 PE ratio. So we'll call it a PE ratio of 50. So what that means is this company has consistently traded at around a 50 PE ratio all the way back from the time they became profitable back in 2006. So to value a company, you really only need two things. You need the future PE ratio that the company will be trading at, and you need the earnings growth. And from those two things, you can compute the fair value of a company. So we can come back to the Rule 1 Toolbox website, and this website has a margin of safety calculator. And so, like I said, all you need is the future PE ratio and the future growth rate. And the growth rate is already put in. Analysts expect this company to grow earnings at 11% a year. And for the future PE ratio, a couple people have asked me how I like to pick the future PE ratio. And there are a couple ways to do it. For a company that's fast growing, I like to use the growth rate. If the growth rate was 20% a year, then I would put a 20 for the PE ratio. Or the other thing you could do is use the average PE ratio that the company has historically traded at, which we just saw that it was around 50. So I would say the important thing is it has to be consistent with what you're doing. For this company, valuing it at a 15 PE ratio wouldn't really make sense because it's never traded at that valuation. And so for the PE ratio, for the future PE, we can put in a 50. So from this, what does the website tell us? It tells us the fair value of the stock is around $222. And right now it's trading at $365. So what does it tell us? It tells us the stock is overvalued right now, and I would definitely wait for some sort of pullback to buy into this company. Again, this is a great company, so this is one I would feel comfortable buying, but it would have to be at the right valuation. Something we saw back in March when we had the stock market crash is that prices actually got down to this level. It was a low of around $211. And so that is less than the estimated fair value for this company. So that is a place where you might feel more confident buying into a company like this. Now, here's the big problem with what we just did. We assume that this company will always trade at a PE of 50. And honestly, I'm not sure how confident I am in that assumption. I'm not usually a huge fan of these companies that always trade at sky-high valuations, because they are usually very hard to value. And this happens with most of these high growth companies, right? They're growing at 30%, 40% a year, and their PE ratios are like 50 or higher. Some PE ratios get to 100, and this keeps going and everything's going good. And then the growth slows down. And once the growth of these companies slows down, the prices usually tank, because these high PE ratios mean all of this incredibly high growth is priced in. And once management says, oh, well, we're not going to be growing that fast anymore, that's when investors start to panic and sell out of the stock. So I'm not saying that ever will happen with this company. In fact, if you think that this company will keep making breakthroughs in the genetic editing space, and you think that this company will eventually develop the capabilities to do things like be able to cure common diseases, then this could be a very fair price for this company, and we could see it trade at even higher valuations in the future. But the thing is, with a high PE ratio like 50, there's a lot of room for that to shrink even a little that will throw off your whole valuation. And so with this, we see that $222 is the fair value, but if you've seen my videos, you know I always like to buy stocks at a discount to their fair value, which gives me some sort of margin of safety. So we can take a look at that. So we can go back to the fast graphs chart. And so their average PE ratio has been 60. However, if you look, there are times when the stock trades above a PE ratio of 50 and times where it trades below. And so ideally what you would want to do for this company is buy when it is below a 50 PE ratio. And if you want some specifics, we can take a look at a few instances. Back in 2008 during the Great Recession, at its low it hit a PE of around 37. And back in 2011, it was a PE of around 21. And so all I'm doing is looking at the major lows of the stock. In 2016, a PE of 38. And back in this past March with the whole crash, a PE ratio of 40 was the low point of the stock. And so what this means is when the stock is sold off, it usually gets down to a valuation of, I'll say, high 30s to low 40s. And so that's really where I would be looking to buy this stock. It happened not too long ago, back in March. It hit a PE ratio of 40. And what you can see from the history of this company is once it gets into PE ratio of the high 30s or lower, it is usually a good buy and will usually bounce back and has always resulted in the share price going higher. So if I were to buy this company, I would probably wait until the PE ratio got to a 40 or lower in the high 30s. Now, will this ever happen? It may not. With everything that's going on right now, I would say stock prices are highly unpredictable in the short term. So we could easily see stock prices of Illumina go back down to where they were in March, back at, the under $250 level. But we could also see the stock keep going up. This stock has almost doubled since its lows in March, and it could go up even higher. But for me, I'd always be conservative with my estimates and wait until the stock is at a very attractive price to begin buying. Now, that being said, if you really believe this company for the long term, then you could buy, then it would make sense to buy when it was at a 50 PE ratio. Right now, it's overvalued. The PE ratio is at a 57, but if we saw a drop down to the 50 PE ratio, that could be a good place to buy. Now, that being said, if you buy there, it could easily go down more. But if you believe in the direction this company is going in, a 50 PE ratio might be justified. So that's why I think for stocks like this, it's super important to look at the history because their growth rate is only 11%. They're not growing insanely fast. And so if I said I'm going to value this based on a 15 PE ratio, which is what is normally for most stocks, you would never see the prices get down. That would mean the stock would be at under $100 right now, and that is probably never going to happen for this company. This stock is probably never going to drop down under $100. So it doesn't make sense when analyzing high growth companies like this. So again, you can use the 50 PE ratio as a fair value for this company. Again, that does make it more unpredictable because there's a lot more room for the PE ratio to expand or shrink based on the future expectations of this company. So those are my thoughts on Illumina stock. Let me know what you think in the comments. Let me know if you own this stock. Let me know if this company is ever going to be able to cure cancer or something like that. And if there's another stock you want to see me analyze in depth like this, leave it in the comments. And whichever one gets the most mentions or the most likes, I will make a video on it. So that's it, and I'll see you on the next video.